To buy or not to buy? That is the question investors wrestle with as we watch the daily price movements of our favorite stocks. And let's be honest, buying really is the best part. Every buy brings a new wave of excitement and hope. It's exhilarating. There is always a second question, though, nagging us every time right before we press the buy button. That question is this a good price? Welcome to The Quality Investor. Today, I hope to aid in finding that fair price for a group of stocks that I believe have some of the best long-term growth potential in the world. I own a few of these, but there are a couple that I would love to also own. I think it is important to have an anchor in your mind about what you're willing to pay for some stock before buying it. It helps in preventing impulse buys and overpaying for a business. And it forces you to have the ultimate virtue in investing, patience. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. With earnings season winding down, it is time to assess what a reasonable price is for some of these top businesses. These buy prices are based on my own DCF models. Those that regularly watch my videos already know this, but I find a buy price based on 3 discounted cash flow models: a bear case, base case, and a bull case. If the business pays a dividend, I run a dividend discount model, bear, base, and bull case as well, to add an extra data point to my buy price. And lastly, I run an exit multiple comparison against the business's competitors based on the PE ratio. I find the average or median PE ratio of their competitors and apply that to the earnings of the business I'm valuing. For each case, I apply a weight to the model to find a weighted average price. I apply a 50% weight to the DCF model and a 25% weight each to the dividend and exit multiples. And for the base case, I also apply a 50% weight and 25% each to the bear and bull cases. And once all of that math is complete, I have an initial buy price. But there is more. I use a margin of safety to discount that buy price even further. The margin of safety accounts for any forecasting errors in the model. And believe me, your forecasts will rarely align with reality. I use a different margin of safety for each business depending on my own risk tolerance of that business. It will all make sense as I go through the list today. So without further ado, let's dive in. This is the list of stocks we're looking at today. I have 7 of them here. The ones in salmon I do not own, and the others I do own. So looking at Microsoft first, they closed the day at $505.12, and they have done fairly well so far in 2025, up 19% so far. I have a buy price of $475. So right now we're about 6% above where we want to be if we want to add more Microsoft to our portfolio. And the market themselves is implying a free cash flow growth based on that $505 of 14.8% over the next 10 years. Microsoft with a PE of 37 right now, you can see that reverse DCF where the market believes their free cash flow will grow based on this share price here. I'm projecting 15.13% on my base case. And here are the DCF prices for the bear, base, and bull: $412.80 all the way up to $666.34 for the bull case. And you can see here my dividend discount and exit multiples as well. Again, I have them at a price of $475, and you can see that's with a 10% margin of safety. Next, we have Google. Google closed the day at $211.35. But the big news for Google is the judge finally issued their order on what would happen with Chrome that was much anticipated over the last month or so. And in fact, I'd say over the last 12 months, Google has been tepid in the market because of all the uncertainty around regulation, specifically the divestiture of their search business, Chrome. And the judge ruled today they do not have to sell Chrome. So Google is receiving a very nice post-market jump, 7% the last I checked. So we should see some fireworks out of Google tomorrow in the market. Very good news, very good decision all around for Google. I might do a video that breaks that decision down a little bit more in depth, so stay tuned for that. So I have a buy price of Google at $210. They're basically trading right there right now, but they're going to be above that buy price after tomorrow. And the market is giving them a free cash flow implied growth here of 9.6%. Again, that will increase tomorrow with the post-decision jump. Google's valuation summary is as follows. They have a PE ratio right now of 22.5. Expect that to pop tomorrow. It could get up to 25 if today's post-market jump is any indication. The market, again, pricing in 9.6% free cash flow growth. I have them at 12.9% on my base case. So it seems like the days of Google being oppressively undervalued are coming to an end. I have a bare discounted cash flow price here of $203.43 up to $354.26 on the bull case. Google just started paying a dividend, so they have wild fluctuations here on their dividend discount model. And I'm actually using a 20% margin of safety right now for Google. And that's where I'm getting my $210 buy price from. Now, if you're a little bit more bullish on Google or believe they're a lot safer, and with good reason now that the antitrust case is behind us, and I'm sure Google will appeal this decision despite its favorable outcome for them, with a 10% margin of safety, that's a buy price of $233.87. So if you have a very high risk tolerance, Google might be still a good buy under $235. And then we have two stocks that in my view go hand in hand, Visa and MasterCard, the famed duopoly of the payment processing business. Visa is at $350.07, MasterCard at $591.87. My buy price for Visa is at $335. My buy price is at $600 for MasterCard. I've done in-depth videos very recently on both of these businesses. Their growth trajectories are very similar, so please check those out. Visa right now trading a little bit above their buy price, so they would need to come down about 4.3%. MasterCard essentially trading right at their buy price. Just because they're below their buy price right now, I don't know if I would add more at this point. Visa has an implied free cash flow growth over the next 10 years of 10.5% and MasterCard at 11.6%. Next is Netflix. Netflix has been absolutely on fire in 2025. They are up 39% year to date. They've had an excellent year all around. They closed today at $1,214.11. My buy price is at $1,125. So they would need to come down about 7.3% to be worthy of adding to the portfolio. And the market is pricing in a very hefty 17.2% implied free cash flow growth over the next 10 years for Netflix. They are easily the best streamer in the business today. We shall see if they can fulfill what the market is looking for. Taking a look at Netflix's valuation summary, they have a PE ratio right now of 51.5, which is exactly their 5-year average. Their forward PE at 47.2 sits right in between their 5 and 10-year average. And like I said, the market has a free cash flow growth here of 17.2%. My base case DCF is pricing them at 21.5%. So on a DCF basis, I'm quite bullish on Netflix. Their discounted cash flow price here is at $913.32 on the bear case, up to $1,937.85 on the bull case. So that means on the bear case, I'm projecting 16.1% free cash flow growth, and on the bull case, up to 26% free cash flow growth over the next 10 years. They do not pay a dividend, and I don't have an exit multiple for them because I don't think there's a lot of very good comps out there for Netflix. Netflix is a pure streaming play, and all the other entertainment businesses out there just have too many other parts and components that really throw off a good comparison on a PE basis. So there's considerable upside here on Netflix if they simply execute, and if they execute at an incredibly high level, there's incredible upside, but that's why we have a margin of safety, and I'm putting in a 20% margin of safety for Netflix, which is where I get the $1,125 buy price from. Next, we have ASML Holding. I did a video back in late March, I believe, on ASML, and at that point, they were trading under $600, and I felt like it was a very good buy, and I did not pull the trigger. And since that point, they have reached as high as $823. I do regret a little bit not adding it to my portfolio then. I have a buy price now at $730. They did fall a little bit after their Q2 earnings. They're down, like I said, to $725. Right at that buy price. I do not think I'm going to add it now. I might regret that again in the future. The market is implying their free cash flow growth over the next 10 years of 7.1%. Finally, we have the biggest dog on this list, Salesforce, ticker CRM. They closed the day at $252.86. Salesforce is down 24% on the year. They've certainly been out of favor. I think a big reason for this is similar to Adobe, where the market truly believes that AI is going to completely disrupt their business. I personally do not buy into that narrative. Salesforce is a business that keeps growing year after year. Their growth has slowed down a bit, but they've really exploded in the free cash flow. So I have a buy price at $275, and they're under their target right now by about 8.75%. The market, based on that $252 stock price right now, is implying free cash flow growth of a paltry 1.8% over the next 10 years. I'm not buying that they're going to grow that slowly. The Salesforce valuation summary to me is pretty interesting. They have a PE ratio of 40.1, considerably less than their 5 and 10 year average, both on the forward PE and the regular PE. And this is where the market is pricing in a 1.8% reverse DCF. So you'd think with my buy price of $275 that my free cash flow growth is right in line with 1.8%, but really, I'm growing at 9% over the next 10 years. And I have a bear price on the DCF basis for Salesforce at $345.57 up to $558.31 in the bull. And my bear case DCF, as you can see here, is 5.9% up to a bull case DCF free cash flow growth of 12.2% for Salesforce. Really where Salesforce comes down in the valuation average is their dividend discount. They pay a dividend, but it's a new dividend. So we don't have a good barometer yet of what their long-term dividend growth will be. I have it growing from anywhere of 5% on the bear case up to 12% on the bull case, and then the exit multiple is at $291. Still, each of these bear base and bull cases has some upside here, but with a 20% margin of safety, that's where I'm getting the $275 buy price and a forward PE of 39.1. If they hit their base case, I basically have, without any margin of safety, a buy price of $345.13. I think Salesforce is a strong buy. I still am on the fence myself on whether or not I want to purchase Salesforce. So those are the 7 stocks I wanted to look at today. Later this week, I'll have buy prices on about 7 to 10 more stocks as the bulk of earnings season has come to a close. So please stay tuned for that. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.